It's a holiday shortened week, but we have a lot to get to. Here to discuss what's driving the stock market this week is Phil Neuhart, Senior Director of Market and Economic Research at First Citizens Bank. Phil, great to have you here at the desk.
Thanks for having me. Excited to be here.
So some potential tariffs seem to have the market on edge today. Do you look at this as just noise or something more serious?
I think this tariff noise reminds us of a couple of things. One, tariffs are fluid, right? Just because there's a particular tariff rate assigned to a country or region does not mean it is final. Additionally, I think it's a reminder this administration is going to use tariffs beyond just economic policy, but as a foreign policy tool. Times like this, we remind clients to have a plan and stick to that plan. This is noise, right? And as we were reminded early last year, if you react and try to time markets at times like this, that is really when you can impair a portfolio. Try to look through this, try to make sure you're allocated properly and not focus on the headlines of the day.
Okay, so dig into what that plan should be
Yeah.
to kind of navigate some of this noise.
Yeah, so one, we believe in diversification, right? And that's, of course, something that can sound boring, but it's really an important tenet of the markets. We are positioned for broadening. That is important in our view. We're overweight small caps, for example. We have international diversification. And then also think about the balance in your portfolio. Unlike a few years ago, fixed income really is a viable asset class. You have yield in fixed income. The aggregate bond yielding over 4%. Municipal bonds are yielding. So we do think that there is return to be had and coupons to be had in fixed income. Don't focus just on equities.
I want to talk to you about the international diversification for just a second, because the Sell America trade seems to be gaining a lot of traction.
Right.
Are you saying to diversify internationally because of what's going on, or because of valuations? I guess, would a potential trade war over Greenland make you not want to buy U.S. stocks?
It's really been more a valuation story. We are still fully invested in the U.S., but we think there are opportunities internationally. For example, we're overweight international small cap. There is a valuation story there. That was a trade we had on last year as well and did work as you look back at 2025. But no, we are not in the Sell America camp. We think that much like last year, a lot of that is noise, to be honest, and that America still stands very strong from a financial market perspective.
Do you think that your portfolio should be more heavily skewed international or balanced, I guess, with U.S. exposure?
More balanced, to be clear. For example, emerging markets, we're actually underweight emerging markets. We think that's a volatile asset class in a volatile time. So it is not skewing heavily towards international, but having that diversification, that balance in your portfolio is important.
And what about tech? What sort of tech exposure should you have in 2026? Because it's been underperforming aside from a few not Mag 7 names for the most part. How should investors be thinking about potential gains there?
Yeah, so first, if you're invested in the U.S. stock market, you're going to own tech just because it's such a high portion. 7 names, 40% of the S&P 500. If you look within our equity portfolios, we are up in quality. We have a factor-based approach. So what does that mean? That means we like things like profitability, profit margins. We're underweight things like leverage. That does actually push us towards tech. We are overweight tech, but also towards some more defensive sectors, consumer staples, for example. Utilities are another example. So a little bit of a barbell approach where we don't think you should be, as you mentioned, just in Mag 7. Diversify across the 500 and honestly, as I mentioned, even into places like small cap.
So is it time to rotate sectors, or is it time to have a broad market approach?
You know what? The answer is a little bit of both.
Yes to both.
So what we choose is one, we keep sector constraints in terms of our allocations. We want to be invested in the market. That said, we have more tilts. So we don't think that you rotate sharply, as in you just completely exit something like technology. That's not our approach. We think you want exposure. You want exposure to the marketplace, but tilts is more how we think about investing within the equity market.
I was taking a look at your 12-month S&P price target. It's 7,200.
That's right.
That's only, I guess on a down day like today, it's a little bit more than modest upside, but it really is only modest upside from here. If that's the case, are stocks actually the best place to be?
So we come into this year cautiously constructive. Our price target, as you mentioned, is up mid-single digits from here. That's an okay year. It's just nothing like what we saw the last 3 years. We don't think that we move to that price target in a straight line. We do expect volatility. I'm not saying that just because of today. It's something that we expected coming into this year. The smooth ride of the back half of last year, we think it's difficult to persist. There is a tension between elevated valuations, but still good earnings and margins. You need to be invested in U.S. stocks. That is not what we're shying away from. But the expectation that returns are always going to be 15, 16, 20%, we're not so sure. We think that positioning for broadening, thinking about other asset classes is wise in addition to large cap stocks.
So what's your best advice for investors right now, especially as they think about navigating some of the choppiness that we've already seen and we're only in the first month of the year?
Yeah. Look, if you're an investor and you look at a day like today, which the market is selling off, again, it's not selling off incredibly.
Right. This S&P is still only, 2% away from all-time highs. Yeah. So are these the dips that they should be buying?
Yeah. So when you look at this, this is not really a sell-off. It might just be a little bit of volatility. But if this is enough to give an investor pause and panic, then I think you really need to look at your overall allocation, right? Mm-hmm. That is an indication of a problem. Equities are a long-term asset class. If you're looking at equities as short-term, that might be problematic. That's why we have short-term fixed income. That's why we have cash. There are other places to be. If you view equities as, hey, this is a multi-year investment, a little bit of noise is something you can look forward to, or look through, I should say. And that's what we emphasize to our clients.
How should investors be thinking about cash this year? Because mid-single digit upside, I mean, my online savings bank aren't paying 5%, but they're paying what? 3.7, maybe 4%.
That's right. Look, the Fed's cut 1.75% since late 2024. So your cash is not yielding what it once was, but there is still yield there. I think you have to think of that as look, short-term needs. That's what cash is. We have encouraged for years now, knowing that the Fed was going to cut, we've encouraged for longer-term assets to extend duration, buy some fixed income, right? Lock in some yield. And there's still the ability to do that, right? You can still do that. Assuming that the yield on money markets is going to be there forever, we don't think is wise. The Fed, we think the bias is still cutting probably in the back half of this year, meaning those yields are going to come down.
And just dig in a bit more into where some of those good opportunities in fixed income actually are. Where are you finding the best yield? Yeah,
so first of all, we prefer investment grade. Spreads are pretty tight, and we just don't see the juice being worth the squeeze in lower quality. So we like quality investment grade. We are investing in both treasuries and corporates. To be clear, we're fairly duration neutral. We do not have a major duration bet on. Long-term yields have certainly moved higher. We don't want too much exposure to that duration risk. So we find really across the yield curve, there is opportunity. But on the corporate side, our fixed income team is very focused on security selection at periods like this. With spreads tight, you don't want to chase risk.
Okay, so we hit on fixed income. You want that in your portfolio. You hit on tech. You want that. You want exposure to international markets, not necessarily emerging markets. Pretty diversified here. What's one area or more than one area that you would avoid right now?
Yeah, look, I mentioned we're underweight emerging markets. We're also underweight large cap value. We're overweight large cap growth. Large cap value, when we look at fundamentals, sales, et cetera, not quite as robust as large cap growth. This has been a change in the marketplace over recent years, is where a lot of the quality is actually in growth, less than the value, which is not always, or more so than value, which has not always been the case. So really our major underweights: underweight emerging markets, underweight large cap value. Otherwise, we're either overweight or kind of neutral.
What's the biggest risk to the market right now?
You know, what are people not thinking about? I think there's a couple things. On the positive side, we were talking a lot of negatives when there's a sell-off. I don't hear a lot of people actually talking about the risks of the bull case, right? In a period in which markets have been up, there's a lot of focus on what the risks are to the downside. There is risk to the bull case, and we're guilty of this, by the way.
Risk that you could miss out.
Yes, there could be upside. On the downside, which I think is the tenor of your question, it's consensus, and our base case is that we're entering more of a disinflationary environment, right? We have seen CPI come in. What if that is one time? What if we see a reacceleration? We're talking about trade and tariffs. If we see an acceleration in inflation, I think that would have implications for longer term yields and for the Fed and thereby risk assets. Not our base case, but something that I just don't hear much talk about anymore is what if inflation remains sticky and even reaccelerates?
And what would make you more bullish?
What would make me more bullish? One, estimates for 2026 are quite high. If you look at S&P 500 earnings estimates, higher than 2025. If we hit those numbers, that makes me feel really good because that means margins are expanding. Also, what is happening outside the Magnificent Seven? Seeing the 493 perform, seeing the equal weight S&P outperform the cap weighted, I feel good about that. I like seeing small cap outperform. We cannot be just mega cap companies. We need to see expansion outside of that. So some of what we're seeing early this year, that makes me feel pretty good, is we're not only hitting numbers, but we're seeing growth outside just those largest names.
Okay, we'll leave it there. Phil, really appreciate your insights. Thanks so much.
Thanks for having me.
That's Phil Neuhart, Senior Director of Market and Economic Research at First Citizens Bank.